and I welcome you all to this session. We're getting a bit of a slow start this morning, but I'm sure there'll be more people joining us. And I certainly want to welcome you all to the 2013 Annual Legislative Conference and this particular session entitled The Elusive Dream, Affordable Housing and African Americans. My name is Marjorie Innocent, and I'm the Vice President for Research and Programs at the Foundation, and really pleased to be here with you all today and for your participation in this conversation. As many of you might know, part of the work that we do at the Foundation does focus on economic and community development, and we certainly recognize that housing is a very, very critical component of that. My particular background is actually in health and social policy, so as a result, I definitely recognize the importance of housing and environment to people's health and well-being. And so this has particular significance for me as well. And a number of the wonderful speakers that you are going to hear from today have actually partnered with us in the past to organize sessions on housing. And while we recognize that there are some real efforts that are underway, and there's been some measurable progress in really helping to preserve homeownership for African Americans, and certainly efforts to try to stymie efforts that might actually become disruptive, if you will, to the homeownership process. We fully recognize that the economic downturn has had a significant impact on people's ability to be able to buy a home, maintain a home, and to even be able to get affordable rental opportunities, particularly in areas where they've got access to a lot of other services. And so we really wanted to continue that dialogue, see where we are today, and really get a better sense of what's happening at the federal level, and really have a good conversation also about how best to move forward. So we certainly are happy that you all are here to participate in that conversation with us. I'm also very, very thankful that when the information about this session went out, if you will, into the broader world, one of our big partners at the Foundation, State Farm, stepped up and said, hey, we really would love to partner with you to organize this session. And in particular, I want to say thank you to Mr. Victor Anger, who's also a board member of ours. You'll hear from him shortly. Ron Betty and Darlene, who have played a really, really important role in the work that we do at the Foundation. And they actually are big supporters of our work, not just around housing, but also the Leadership Institute work that we do, in particular, one of our internship programs, the communications internship programs. And I do apologize, actually, it's Regina Dillard that I wanted to say thank you to, and really, really, they have been such wonderful partners of our work, and we're very, very thankful for that. At this time, I think I'm going to go ahead and pass the microphone to Mr. Victor Anger, who's going to share with us some comments and some welcome remarks.
Good morning, everyone.
Good morning.
Thank you for being here. As Marjorie said, my name is Victor Anger of State Farm. I'm Vice President of Agency here and responsible for the Metro D.C. area, and as she mentioned, current Congressional Black Caucus Foundation board member. On behalf of State Farm's 69,000 employees and over 18,000 agents, I'd like to extend just a warm welcome to this conference. I'd also like to thank CBCF President Shanice Washington and her team for just orchestrating another excellent legislative conference. I also like to thank Dr. Marjorie Innocent, just for her vision and just bringing together such an influential group to discuss an important topic to all of us in our communities. Thank you also to the excellent moderator, Onisha Herring, and our distinguished panelists. And finally, I'd just like to thank the members of the Congressional Black Caucus who have been positively influencing, the course of events that were pertinent to African Americans since 1971. State Farm has been a proud partner of CBCF since 2002, and we're delighted to support the State Farm Communication Internship Program, which provides opportunities for college students to work directly in the communication offices of the federal legislators. We also provide funding for the Center for Policy Analysis and Research Fellow, who will focus on program and policy information and solutions in the areas of affordable housing and community revitalization. Additionally, State Farm is a longtime sponsor of this conference, as well as the Mervyn L. and Stephanie Stubbs Jones Memorial Scholarship Classic. So you may be asking yourself, what State Farm has to do with this session on affordable housing. I mean, as you know, we make it our business to be like a good neighbor, and it's important for us to continue to help and build safer, stronger and better educated communities across the United States and Canada. State Farm's comprehensive approach to community development work is grounded in empowering individuals to overcome adversity and eliminate barriers to buying their homes for the first time and becoming business owners. We assist national and local community development organizations in their efforts to transform distressed neighborhoods into healthy community where residents live, work, and raise their families. In addition to CBCF, State Farm partners with organizations such as Local Initiative Support Corporation, Enterprise Community Partners, Raza Development Fund, and National Fair Housing Alliance, just to improve communities, among others. State Farm has enjoyed a long beneficial relationship with NAFA dating back to the mid-1990s, when our organization joined forces to advocate for fair housing. And we recently sponsored the NAFA's 25th anniversary and the Fair Housing Act's 45th anniversary here in Washington, D.C. Solutions to issues impacting fair and adequate housing start with sessions like this and people like yourself. So once again, just thank you for your participation. I'm absolutely positive you'll take something from this session and this group. And before we do this, I'd like to share just a brief video that highlights just some of State Farm's work with the community partners just to improve lives and our communities.
As part of that work, in addition to the communications internship program that you've heard about and our other internship programs and our scholarship programs, we also have some fellowship opportunities that we think are really terrific and that we're really proud of. And I'm especially pleased that our moderator today is actually an alum of that program. She actually was a congressional, and there's another one in the back, very exciting. She was Onisha Herring, who is legislative counsel at the Center for Responsible Lending, was actually one of our congressional fellows focusing on housing in 2010-2012, and she will absolutely lead our conversation today. And I now pass the mic to her and say thank you so much, Onisha.
Good morning, everybody. So we have a small group, but an influential group, so numbers mean nothing. We're gonna make this a really good discussion today, and I'm really excited to be here giving back to a foundation that has poured into me, and I'm eternally grateful for the fellowship and the experience I had. Again, my name is Onisha Herring. I am legislative counsel at the Center for Responsible Lending, and today's panel is going to focus on U.S. housing policy and how it affects African Americans, particularly affordable home ownership as well as rental opportunities. The past decade has proven to be a very turbulent period for the Black community. The housing market crash, the Great Recession has left many African Americans barely clinging on to the middle class and at a higher risk of poverty. It has depleted the small economic gains which were made over the last 20 years, and home ownership, which has largely been our primary means of accumulating wealth, now remains dismal. According to the census data, 46% of there were 46% of Blacks that were homeowners in 2010, while 74% of whites owned their homes. The Center for Responsible Lending estimates that nearly 8% of recent Black and Latino mortgage holders lost their homes to foreclosure between 2007 and 2009. That's compared to only 4.5% of whites. The loss of homes and jobs has left the Black community losing over half of its net worth. While African Americans are literally holding on to dear life to the American dream of home ownership, revitalization efforts and gentrification expands in urban communities, both large and small. This makes actually finding affordable rental housing an increasingly difficult feat, especially in places with quality transportation, schools, and thriving businesses. In today's session, we will explore short-term and long-term outlook on affordable housing and rental opportunities, as well as the impact of neighborhood revitalization on these trends, the role of the federal policy in addressing the housing crisis, particularly as it relates to the Black community. With that said, I'll go ahead and briefly introduce our panelists and map out our discussion for today. First, we will have Nikitra Bailey, who is Executive Vice President for External Affairs at the Center for Responsible Lending, discuss short-term and long-term outlook on affordable home ownership and rental housing for African Americans. Then we will have Jim Carr, who is Senior Fellow at the Center for American Progress and Distinguished Scholar with the Opportunity Agenda, discuss the impact of neighborhood revitalization on these trends. We will have Lisa Rice, who is the Vice President of the National Fair Housing Alliance, discuss the recommended federal policies on how to address affordable housing needs for low-income and moderate-income African Americans. And then finally, we will have Maurice Jones, Deputy Secretary of the U.S. Department of Housing and Urban Development, discuss some of the federal measures currently underway to address some of these issues. After which, we will have a 30-minute question and answer period from the audience. And finally, my favorite part, we will have our wrap-up. We'll include, and the reason why it's my favorite part is because it's the takeaway. It's what we can use, what we can actually implement and take into our communities. And our panelists will also give their key points from the discussion today. So we will go ahead and start with Nikitra Bailey, who is the Executive Vice President for CRL.
Good morning, everyone. Thank you, Onisha, for your introduction. Onisha's dedication and commitment to excellence make her an asset at CRL. We are very proud of her work, and we are thankful to the Congressional Black Caucus Foundation for its Fellows Program and for training future leaders to have impact today. I'm grateful also for the attendance of my other colleagues, Mr. Keith Corbett and Ms. Araceli Panameno. Both of them are really influential in this aspect around housing policy and help us maintain a very vibrant relationship with the Congressional Black Caucus Foundation. And then I'd like to thank the sponsor, State Farm, and Dr. Innocent and the Congressional Black Caucus Foundation for your hosting of this important conversation today and for inviting us to be a part of it. And I'd like to say hello to my dear friends, Ms. Lisa Rice and Mr. Jim Carr. We travel deep on this policy. I've tried to be a mentor to Onisha in the manner that Lisa and Jim have been a mentor for me. So let's jump right into it. CRL is an economic justice advocacy organization. Our advocacy is rooted in our belief that fair financial services strengthen families and whole communities. We are affiliated with one of the nation's largest community financial institutions, Self-Help. Self-Help started in 1980 in North Carolina as a very small credit union with an investment of $77 from its co-op members. Give me a moment here. This microphone isn't my friend. Today, Self-Help's lending is national, and we have provided over $6.8 billion in financing to families, individuals, and organizations through our direct home lending, secondary mortgage market lending, community facilities, and business lending programs. We also provide consumer financial services such as savings account and consumer loans. Housing is a pillar of our nation's economy. There are currently $10 trillion of mortgage loans outstanding. Thus, we all have a vested interest in a healthy housing market. Our experience with the recent foreclosure crisis, which was the result of abusive subprime lending, showed that a volatile housing market has severe ramifications for all of us, whether we are a renter or a homeowner. As a result, we have had a net drain on our economy as a whole, and 5 years after the mortgage market meltdown, we know that when we allow abusive mortgage products to plague some communities, all communities ultimately pay the cost. So there are some factors that led to foreclosure that I'm going to run through pretty quickly. I think it's well established at this point, but I want to highlight some trends that we saw that kind of got us here. And I want to predicate it on the fact that by the time we got to these abusive mortgage products, predatory lending had been rampant in our communities. We had really worked to push back against it, and the Center for Responsible Lending did advocacy in many states, North Carolina being the first state to pass anti-predatory lending legislation to stop these abusive practices. And what you're going to learn from this conversation today is that the industry itself consistently morphed. Every time we thought we were pushing back and stopping abusive practices from inundating our communities and causing real financial harm, the industry figured out a way to continue to go forward. And as a result of that, we are all building our way out of a very difficult situation. So subprime lending really didn't have a lot to do with home ownership. The vast majority of subprime loans were actually home loan refinances. So what we often hear is that a lot of people who didn't qualify for mortgages ended up getting loans that they didn't deserve. Well, we know that's not true. Many of those families had already been in their homes living in as established homeowners. So subprime lenders were really preying on families in communities that had a history of home ownership. So it's not true that these loans helped or pushed home ownership in any way. And then this product was so dangerous in the subprime lending. There was this 228 mortgage product. It was designed to fail from the outset. The lenders knew it and the securitizers on Wall Street knew it. And they are responsible for its proliferation in our market. And I want to talk about this product a little bit because in consumer protection, if something's going to hurt a consumer, there is federal regulation to stop that practice or product from hurting a consumer. And at the time, luckily today we have the Consumer Financial Protection Bureau, but at the time we didn't have anything to stop these harmful practices from really hurting our community. And we didn't have anyone standing up and fighting back for us at that regulatory level. So these mortgages were for 2 years at an initial interest rate, and then on a third year, they had an adjusted payment shock of 30%, and that shock would continually rise. And it was predicated on the fact that we had rising home equity and home value. We had rising home values as a result of increasing home equity. So these mortgages were set up so that they could be repeatedly refinanced, so that the lenders and the brokers could just extract a lot of fees out of these loans up front. So these products by design were dangerous and just really unnecessary in our community. And it's really important at this point to talk about why the crisis shouldn't have happened. Because I remember my colleague back in 2006, we released a report called Losing Ground, coming out saying, you know, this is a year after Hurricane Katrina. Guys, we are going to have a ton of little Hurricane Katrinas all over our nation if we don't stop these practices. And I remember the mortgage industry coming after him very strongly saying, you know, you're just exaggerating. You guys are, you know, trying to drive us out of the market, and you're making these unfair claims. But he was absolutely right. And what has happened as a result of that is just massive devastation in our community. So like I said, there was weak regulation. The Consumer Financial Protection Bureau, which I will get into later, wasn't up and running. None of our federal regulators were willing to stand up and take the necessary action that they needed to take to protect homeowners. There were some states where a lot of activity was going. I highlighted North Carolina earlier, where states were responding because mortgages are local. They happen in communities, and state legislators understood that they needed to do something. But for some reason, we couldn't get the federal government to act as fast as we had hoped. And then finally, poor loan servicing practices. What we know is that once foreclosures actually start, the loan servicing wasn't set up in a way that they could handle the capacity of the amount of foreclosures. So the sheer volume of the foreclosures, coupled with the very disconnected practices of the loan services, added a ton of layers to the foreclosure process that we're kind of digging our way out from, which I expect the Deputy Secretary to speak more about, so I won't harbor on that point. So let's move on to the evolution of the mortgage market. I want to show you this slide because what it shows you is that when subprime lending initially started, it was only 10% of the market in 2000. And because of the money involved in it and the profit that Wall Street was getting, it eventually became 39% of the market. And as a result of that, it had such a major impact that when any adjustment to it happened, it was going to have broad market ramifications. And then national foreclosures. For many of our communities, foreclosure started a lot sooner than they did in other communities. And if you look at this chart, you'll see that foreclosure started edging up in late 2006, and you'll see that peak in 2009. So for African Americans in particular, because we were disproportionately steered into abusive subprime loans, many of the loans that we didn't qualify for, foreclosures hit our community before they hit a lot of other communities. So what you hear people say is, well, foreclosures happen because of massive unemployment in the African American community. No, unemployment was the result of closure in African American communities, and that's something we have to be very clear about. So is this crisis over? Absolutely not. We wish it was. And I want to thank State Farm for showing that video, because what that video demonstrates is the human aspect of what we're talking about. We're not talking about just numbers and figures. We're talking about lives. And when I think about foreclosure, I like to think about kids in particular. When you are a homeowner, you're making an investment in your future. And if you have a family, which I'm, the mother of adorable 17-month-old and a 9-year-old, you know that you're thinking long term, and you're making this investment because you want those children to have an opportunity for prosperity in the future. So thank you, State Farm, for having such a powerful piece to demonstrate the touch and the impact. When you look at that kitchen counter where, you saw trash and things discarded, shouldn't that have been a picture of kids sitting there getting help with their homework from their parents? Because I bet you when those parents purchased that home, that's exactly what it was they were thinking about. So the foreclosure crisis isn't over. We've had 4.4 million homeowners lose their homes since 2008, and states that have the highest number of completed foreclosures include Florida, California, Michigan, Texas, and Georgia. And as of April 2013, the Deputy Secretary may have more updated information, 52,000 homeowners lost their homes to foreclosure this year. And as of April 2013, 1.1 million homeowners were actually in foreclosure. And as we're talking about equity in a home, 9.7 million mortgages have remained in negative equity. And of the mortgages that are not in negative equity but have outstanding positive equity, 11.2 million have less than 20% equity, and of these, 2.1 million have less than 5%. And this final number is really important because when we're thinking about helping families refinance out of foreclosure, the amount of equity in one's home make it more likely that a refinance can happen. So that's really important. And then, like I said earlier, because of the abuses in the subprime market, we've had a disparate impact on communities of color of foreclosure. So at the end of this crisis, when it's all said and done, and we're starting to come out, and Jim will go into better details a little later about how we're coming out, 20% of all African Americans and Latinos will lose their homes during this foreclosure crisis. Now think about the economic impact of that, and also think about the wealth loss of that. So our home ownership rates are going to drop. We hit a high of 49% in 2004 to 42% and 44%, and it's still going down. It hasn't stopped. So I'm putting this in the context of the March on Washington. We were all just there at the Lincoln Memorial in August to celebrate that event. But the sad part is when we think about the wealth that our community took generations to build, and I just watched The Butler, so I'm still a little emotional. When our parents and our grandparents had to take jobs that did not provide them with dignity and an opportunity that many of us enjoy today, to see that hard work and that effort to help us build wealth and to become the people that we are today just wiped away instantly. It was 50 years of toil just gone. So that's something that we have to think about. And then we also have to think about the effect on public education. We're going to have 2 million additional transient families in neighborhoods of color. So that means we're going to have children displaced all over looking for opportunities for education, and that's going to have a significant impact around our nation. And the spillover costs for foreclosure don't just impact the families who've been foreclosed upon. When we think about neighbors who live next to a foreclosure, we know that $2.2 trillion in lost property value has been lost, and that the average spillover cost per family is or will be $23,000. So that's a significant amount. And when we think about the total cost of all of us as a nation, because if you owned a home and a foreclosure happened in your neighborhood, your property value declined as well. So we're talking about $7 trillion in total home equity loss, and some estimates go as high as 13. So why do we care about home ownership? Because in America, how you have an opportunity to climb up this economic ladder has a lot to do with home ownership. Most Americans have relied on the wealth created through home ownership to provide better opportunities for themselves, their families, and their communities. And for African Americans in particular, and Latinos as well, home ownership is our primary wealth vehicle. It is what we have. It is the thing that we pass on when we're no longer able to be here. So home equity as a measure of wealth for African Americans is 62%, for Latinos is 67%, and for white Americans it's 38%. So when we get a shock in the housing market, some communities get a cold, African Americans and Latinos get an outright flu. Marjorie insisted that I talk about renting today, and I think she was really smart to do so, because what we know from the foreclosure crisis is that a lot of families now need somewhere to go. And we have to really talk about rental housing very carefully, because we want to make sure we have affordable and quality rental housing, because it is really important that all families have an opportunity for decent and quality living. But we also want to be very, very careful, because as the result of subprime lending, we've received a massive pushback on this idea that African Americans and Latinos can successfully be homeowners. We know that they can. We know that when the products are regulated and proper, that the opportunity for us is similar to others. So we want to make sure we don't take away from that. But as I delve into the detail on renters, we want to talk about how 35% of our population is comprised of renters. 42% of those persons are people of color. Renters are typically young, low income, and single household. And there's this shift today, I think, and Jim will get into this more later, around whether or not younger people even want to become homeowners, whether or not they want to be in situations like their parents who were in suburbia. We are having a massive reshift to inner cities and coming back to places that are walkable. And young people have a different feeling about their futures than well, I have to say me too. Some of us who are getting a little older now, I checked the box recently and I'm not in the old box. The median age of a renter is 40, and renters have a median net worth that is $5,100, and you can see that it goes down for Latinos and African Americans. And this is really something that I think is really important. Renters also have less cash savings. So out of their wealth, which is typically an automobile, that they have to get to and from for work. Out of the wealth that they have, they only have about $1,000 in cash savings. So we have a real question about housing affordability in communities of real opportunity for people. So that's going to be a challenge going forward. And then I want to end talking about where we are now. There's a lot of debate happening in our capital around reforming the secondary mortgage market. And I tell you, this has huge implications for us as a community. We're making a decision right now about who and how people will be able to participate in the future mortgage market. And we know from our lending experience, we're not an advocacy organization that just likes to get up and pontificate about what we think should happen. Our experience is predicated in real best practices that we know work. So we've been making loans to communities, particularly low income and low wealth families, since 1980. And we know that from our experience, families will do whatever they can to ensure that their mortgages are paid. So a typical family is going to need to save 22 years for a 10% down payment, because everyone's having this conversation that we have to have some skin in the game. Well, typically the market decides what skin in the game is. But for some weird reason, people here in Washington, D.C. think it's a good idea for Congress to decide how much a down payment should be. And if that does happen, you can see there's going to be a delay in home ownership. And I want to pause on this point because we're talking about the time for African Americans, Latinos, whites, Asian Americans, all of our population in that first bullet. But when you get to that second bullet, you see that a 10% down payment would take 60% of successfully paying homeowners, African Americans today who are paying their mortgage successfully, out of the market, and 50% of Latinos as well. And this number does not even factor in the rising costs associated with student loans. Many of our people are already graduating from college in severe financial debt. So by the time they get a chance to even try to climb out of that debt hole, if we add these down payment mandates, our community is going to be further pushed behind. And this is not the time to be pushed behind in housing because there is a sense of affordability. Interest rates are at record lows. They're rising right now, but they're still at record lows. So we don't want to allow that to happen. And as this third bullet point shows, there's also a delay for a 5% down payment. It's just not a good idea to have the federal government mandate a down payment. And then I'll wrap up with my final points. As we think about the secondary market going forward, we have to make sure some key things are in any final legislation. Right now, there's a lot of talk about a preliminary start point. We're trying to stay focused on where we ultimately end. We know there needs to be a duty to serve. I won't take Lisa's talking points. I'm going to skip that one. We need to have... Go ahead. We need to have a duty to serve because it's really important for all communities to have an opportunity to participate in the mortgage market. Like I said, the mortgage market is a significant pillar in our economy, and we have a significant amount of older Americans who are going to be needing to downsize or get out of their housing. And if they don't have that option because African Americans and Latinos don't have access to purchasing those homes because they can't get mortgage financing, our housing recovery is going to be in limbo. And that's something that, again, has a broad impact on all of us because what we learned from the foreclosure crisis is that when there's shakiness in housing, there's an increase in unemployment. So there's a correlation that we have to be concerned about. And then we need to make sure we have broad market access so that lenders of every size can participate in the market. And this is really important for smaller financial institutions. And then we need to make sure we have an explicit and fully paid for government guarantee. Jim is going to really stress this point, so I'm going to jump to the limited portfolio capacity. As a lender, we know that you need to have an ability to take loans out of your securities at times because of distress that borrowers might feel. And also when I think about rental housing is very different because geographically as a nation, we're very different. And rental needs in one part of our country aren't the same. The majority of African Americans live in the South. It's different there. Way different than it would be in California. So we need to have an ability to go in, pull mortgages out, and do what's necessary or to create special financing so that we can extend quality, affordable, multifamily housing going forward. And then I'll end with the fact that we must confirm Mel Watt to lead the Federal Housing Finance Agency. The administration nominated Mr. Watt. He is a person who has practical experience and leadership on this issue. Prior to getting to Congress, he was a brilliant lawyer in North Carolina. And since he's been in Congress, he's been a real champion, very smart and very practical. He's not one-sided at all, and he deserves an opportunity to help lead us forward. Thank you.
Thank you, Nikitra. Now we will have Jim Carr, who is Senior Fellow for the Center for American Progress.
Good morning. Give me just a second while I try and get organized here because there's a computer and I have remarks. So first of all, let me just say I'm honored to be asked to share some thoughts with you today, particularly by the Congressional Black Caucus Foundation. It's hard to find a more important issue to talk about than housing and in particular home ownership. But before I begin my remarks, I just want to ask Nikitra, what did she mean by she checked the young box? and then looked at all her colleagues. Did you see Lisa and I were looking at each other? She stared at Lisa and me. Yeah, so I guess we don't get to check the young box. But we're mentors, so we don't have to. So I was asked to talk about the housing market and then also add some thoughts about community investment. But I think you're going to see that really the housing market and community investment are all really intertwined. And in fact, in my view, it would be kind of hard to talk about community investment without talking about the housing market. Because when we're talking about rebuilding communities, what are we talking about? We're talking about, first and foremost, what does the shelter look like in which people are living? Are they renting or owning? If they're renting, is it affordable? If they're owning, is it sustainable? And so in terms of putting together this conversation, will be tracing some of the territory that Nikitra covered. But I think I'll have some very different perspectives on a number of the statistics, even though some of them will be very much the same. Now, as we all know, the single-family home is the most important asset to the typical American household, and as Nikitra pointed out, particularly for African Americans. And due to the importance of the family home, the foreclosure crisis of the past 6 years, as you all know, has been devastating to communities across the country, particularly communities of color. The combination of the collapse of the housing market and the Great Recession that began in 2007 have resulted in extremely high levels of unemployment, a dramatic reduction in the homeownership rate, and a massive loss of wealth, again, particularly for blacks and Latinos. But as Nikitra pointed out, the crisis is not yet over for African Americans and Latinos. And in fact, neither crisis. So it's important to recognize that we've talked about unemployment a couple of times, but the fact of the matter is that at the depth of the crisis, unemployment nationally was just touching about 10%. But for African Americans, it remains over 13% now. So we're 3 percentage points higher than the peak of the crisis. Moreover, African Americans have experienced the highest levels of underemployment. And so what that means is people who want full-time work but can only get part-time jobs and or temporary jobs. And then our number of 13% still is a positive number because the fact of the matter is the way we measure unemployment, we eliminate those people who have dropped out of the labor market. Well, labor market participation now, needless to say, African Americans have the highest level or the lowest level of labor market participation. But yet we have an unemployment rate that's more than twice that for non-Hispanic whites. So the crisis for us in the economy is not over, and therefore the crisis for us in the housing market is not over. And as Nikitra pointed out, our crisis started as a result of the foreclosure crisis, but now it is driving full steam ahead as a result of an inability to get a good job. Now, we know that African Americans, the homeownership rate has dropped dramatically. I don't know if Nikitra, I don't remember her pointing out the stats, but we were just under 15%, and now we're down to just over 43%. And I believe it's the Center for Responsible Lending, Martinique's, that's estimated that it could drop to as low as 40%, and that would represent a full 20% loss of homeownership. The loss of jobs has resulted in a catastrophic loss of net wealth. Loans backed by Fannie and Freddie are all but impossible to access now for African Americans. And so we don't just have a loss of homeownership as a result of the foreclosure crisis, but we have a loss of homeownership because we just simply can't get mortgage loans even though we're qualified for them. And so the typical loans now insured by the GSEs are in the high 700s, while the typical down payments are nearer at 20%. And as a result, most of the loans secured by African Americans today are through FHA. FHA has always been a more expensive option, but it is particularly expensive now because of its operations increasing in fees at least 5 times since 2008, trying to deal with a potential loss. It is undercapitalized, technically speaking. Since the start of the collapse of the housing market, the federal government has pursued a number of initiatives to stem the foreclosure crisis, and we all remember them. We painfully remember them. It started with the Hope Now initiative and ultimately became the Home Affordable Modification Programs and many other initiatives in between. Unfortunately, as we all know, all those programs were voluntary. So unlike the bank bailouts, which was money on the spot, immediate and explicit, homeowners who were dealing with challenges dealt with voluntary programs. And in fact, Neil Borofsky, who was the Inspector General for the Top Oversight Committee, made the most profound statement about the HAMP program that I think I've ever heard, which is not only was it a voluntary program to be part of, but whether you in fact obeyed the rules of the program once you were in were also voluntary because they weren't enforced. And so the reason that we've had so many foreclosure filings, as many as 14 million now, just under 4.5 million actual foreclosures completed, but 14 million filings, is because the programs just didn't do a good job. And then after the fact, there were a couple of major initiatives to help us recover from the crisis. So I think it's important that we don't forget those either. We had a 49th State Attorneys General settlement and Office of the Comptroller of the Current independent review. Both of those aimed at getting at restitution for people who were either foreclosed upon through improper processes or who had been otherwise financially exploited. Neither of those efforts did anywhere near recovering the lost wealth. And so just to give you an example, the 49th State Attorneys General mortgage settlement, the highest compensation you could receive, as I recall, was between $1,800 to $2,000. Right, so you lost your home, you get $1,800, $2,000. That's not even moving expenses, right? Or a security lease for a rental apartment, not 2 months worth. So at any rate, I won't go through the details of these settlements except to say if someone wants to talk about them in Q&A, I'd be more than delighted. But my point is, homeowners have been on the short end of this crisis from the very beginning. Not really serious intervention to help prevent the foreclosures, and not anywhere near serious intervention to help people recover from the crisis. And so all this feeds into, well, what's happening at a community level, right? We're talking about community investment. Well, let's keep talking a little bit more. There are a lot of signs that the housing market's recovering. And in fact, if you turn on the standard business news like Bloomberg, they constantly have speakers on talking about two things. One, employment numbers are softer than we'd like, but they look kind of good, right? And on the other hand, the housing market's recovering. Well, I won't talk about the unemployment numbers because I've already pointed out how you can conclude that we're generating 169,000 jobs last month. You need about 150 just to absorb the number of new entrants into the market. And then the majority of jobs we're creating are temporary or part-time. Of those jobs that are full-time jobs, most are in low-pay sectors. So this is a job market that's only okay but not great to billionaires. The same thing is happening on the housing side. So if you look at what's happening in housing markets, the good news is that house prices are rising, construction starts are up, sales of both new and existing homes are up, and mortgage originations are strong. Those are all good numbers. But if you pull back the veil on any one of them, you find the same weaknesses you find in unemployment. So let's look at mortgage originations. For the past year, roughly 70% of all mortgage originations have been refinancing. And for the second quarter of this year, roughly 2/3 of 75% of all loans originated were refinancing. Well, what's wrong with that? Well, refinancing helps borrowers at an individual level to lower their costs, and that's good. And refinancing certainly helps the financial institutions that are involved in the practice. But refinancing loans is churning loans. It isn't creating new home ownership. And therefore, the opportunity to become a homeowner is missed in this refinancing market. And in fact, Fannie and Freddie really are just refinancing machines right now, with roughly 70% of their originations being refis. The other thing is that house prices have been rising. So if you look at house prices rising, that's a good thing. But if you drill down, you see one of the biggest drivers of house prices rising is investors in neighborhoods. We have a significant share of housing being purchased now through investors. And some estimates estimate that as much as 40% of sales in May of this year were investors with cash. Investors are a mixed blessing for a variety of reasons. First, the wealth accruing from rising home values on investor properties does not remain in the neighborhood, but rather goes to the neighborhood of where the investor lives. In other words, the price rises and it's stripped off to the investor. Nationally, 68% of damaged homes sold in April went to investors, while only 19% went to first-time home buyers, and an estimated 40% were purchased for cash. Now think about this. We have the most affordable market we've had in years, or at least we did for the past year, in terms of almost historically low interest rates and low house prices. And who's actually accessing them? Not the very people who could use them. Moderate income households, people of color, actually being able to come back into the market, take advantage of these low prices, take advantage of these low interest rates, lock in a 30-year fixed rate mortgage and be done worrying about rent payments. That would be an extraordinary gift, both for the American public and for the American economy. But instead, what's happening is the doors are open for investors. And the doors just aren't happening to be open for investors because federal agencies have actually created programs to encourage and help and facilitate investors actually buy, to the detriment of first-time home buyers, and in my view, ultimately, the American public. Accessing credit has rarely been more challenging for African-Americans and Latinos. According to the Center for American Progress, mortgage originations for borrowers with credit scores between 620 and 680 have fallen by a full 90% since the onset of the crisis. And according to the Harvard Joint Center for Housing Studies, the median credit score for an African-American borrower in 2001 was somewhere between 676 and 670. Do you think that credit score has gone up as a result of the Great Recession? But a more recent study in 2009 in Illinois found that in zip codes that were 80% or more African Americans, more than half of consumers had credit scores less than 620, and over 20% had them between 620 and 699. So in other words, if the credit score is the driver, we're not in. If the down payment is the driver, we're not in. Well, why do I say that? Because as much as 30% of all loans outstanding that were originated between 2004 and 2008, almost 30% of African Americans had down payments of less than 5%, almost 30%. And if you move that up to 10%, that probably comes out to just under half of all performing loans, not loans that originated, but performing, doing fine, right? So we basically wiped those out of the market. So what's happening at a community level? I think Prince George's County is a classic or is a case book or textbook example of what's happening to our communities. Prince George's County was and still is, I believe, the most affluent county, African-American county in America. And yet, for some reason, it became foreclosure central for the state of Maryland. Wealthiest black county, foreclosure central. It says pretty clearly it's not money, it's not wealth, it's about exploitation, financial exploitation. Well, it was foreclosure central, but last year it was one of the hottest markets in Maryland with house prices rising, I believe, about 10% last year, which was the strongest in about the last 6 years. But who were the buyers? Almost or over half were investors. And so what we see happening in Prince George's, and we see this happening in African American Latino communities across the country, is the great wealth loss is now morphing into the great wealth transfer. Those dollars are going away and not to be recovered. Now, many people have asked, well, what about the Consumer Financial Protection Bureau? Isn't that its job to make sure that fair lending occurs, et cetera, et cetera? And I have to say that the CFPB is the one silver lining and the bright spot in the post-crisis era. The CFPB has hit the ground running, and it has issued a whole host of rules relating to unfair and deceptive practices and indicates that it will be doing more. So it's doing a good job. The problem with the CFPB's role is more of a prohibition role. It prohibits bad lending, but it doesn't necessarily have the ability to promote. So, for example, the CFPB can't do anything about a QM rule. If the QM rule is the QM rule is going to be what rules, right? So how do we actually get a housing market that works for people of color? Well, we need three things to happen. And I hate to say it, but right now, or I hate to bear the bad news, but none of the three are happening. And Nikitra alluded to probably at least two of the three. The first thing we need to do is we need to reshape the housing finance system. And when we say that, the first thing people think about is remake Fannie and Freddie. And I think that's reasonable since Fannie and Freddie are the bulk of securitization in America today, and they are, in fact, by definition, the conforming market. But here's the problem on practically every proposal that's been put forward, every one, is that and I say practically, not everyone, because I know that Center for Responsible Lending has one. I know Dan Immergluck proposed an agency, but with the exception of those outliers, which really aren't front and center the focus of the congressional debate, those proposals basically propose really looking at risk factors. They don't look at what's the point. So they start designing a system without first asking the question, what's the point of the system? The point of the system, if you ask most of the sponsors, is to ensure that there's risk sharing between the public and private sector so the taxpayers don't have to bail out the financial system again. And the irony of that is that the only time the taxpayers have had to bail out the system is when they bailed out private institutions. It happened in the years leading up to the Great Depression, and it happened in the years leading up to the Great Recession. Now, I said that not too long ago, and someone said, well, what about Fannie and Freddie? Fannie and Freddie's problems were caused directly because they had a board of directors who were really pushing earnings. They had a private board of directors, a private executive staff. They were private corporations. Did you see any of their money come into the Treasury? Because I missed it if it did. They were private corporations. And so we need more than just to say that we need to make sure the public is protected. In fact, if the public's going to be standing behind the system, we need that system to be designed to expand affordable home ownership as significantly as the original FHA, Federal Home Loan Bank, and all the rest of these housing institutions that made the typical white household extremely wealthy relative to the rest of the world because of low-cost, affordable home ownership. We need that mandate right now going forward, and we don't have it. The second thing we need to do is make sure that there's adequate supply of financing for affordable rental housing. Many of the proposals set forward don't even speak about rental housing at all, or they say something else has to happen with rental housing, figure it out over here. The problem is that Fannie and Freddie, especially since the crisis, have been almost the only financiers of affordable rental housing. So you can't just get rid of the GSEs and have a functioning rental financing market. You have to deal with them simultaneously. And as Nikitra said, we had a rental affordability crisis long before the Great Recession. And in fact, just last year, rents were up another 5%, while wages for the median renter household actually fell. So we need to get that puzzle straight. And the last piece is we need comprehensive community reinvestment. We know right now that most of the focus in Congress is on debates about deficit reduction. Here's the irony of deficit reduction versus rebuild America's middle class and support populations of color, people of color. Do you remember what happened when Ben Bernanke said a couple of months ago they were thinking about tapering back on the direct stimulus, which is another way of saying subsidies for financial firms? The markets, the wheels almost fell off, right? Yesterday, everyone's holding their breath, and the market, was it yesterday or day before yesterday, hit all new highs. Was this a market reaction? This was a payday reaction because, lo and behold, to everyone's surprise, the Fed chairman said, oops, I guess we won't be rolling back on our stimulus subsidies. And the reason he did that was because just the mere mention that those subsidies to financial institutions would be rolled back caused unemployment to fall, interest rates to spike, and the economy to slow. Just as financial firms need stimulus subsidy, so does the middle class, and certainly communities of color that have been the major recipients of this downturn and economic distress. So I'll close by saying the piece that we need in the community investment piece is not just another. I know some people I'll say not another neighborhood stabilization program, and I'm going to get pummeled by HUD. What, you didn't like that? Of course I liked it. Of course I liked it. But I'd like to have more than $2 billion in the middle of the worst crisis and a wealth reduction that has been the greatest that African-Americans and Latinos have ever experienced. Latinos have actually experienced a loss of 2/3 of their net worth, and African-Americans and Asians more than half. What if that had happened in non-Hispanic white America? We would have stimulus programs left and right, right? But what's curious is middle America, including non-Hispanic whites, have also taken a beating. They are not doing so well either, and still there's no response. So we need a stimulus program, and what I'm calling for is an infrastructure bank, specifically a housing and community infrastructure bank that allows us to promote affordable home ownership, rental housing, and help repair the damage to communities, including schools, community facilities, streets and roads. And why do we need an infrastructure bank? Because we don't need $2 billion over a 3-year period. We need $10 billion every year. But the good news about that is, just as it's perceived by Wall Street to be creating an economy, if you pay people to take a job, they will grow the economy. So investment in infrastructure is not a giveaway. It's an investment in the future of this country. And given the fact that the majority of children born in this country now are people of color, it's about time America wakes up and understands that investment in communities of color are investments in the future competitiveness.
Good morning, and while Onisha is pulling up my presentation for me, there it is, I just want to also thank the CBCF for hosting this very, very important session. Dr. Innocent and Onisha, thank you so much for pulling together such a great panel. And
Hold on one second, sorry. That's totally my fault.
and inviting us to come. And I also wanted to thank State Farm for sponsoring this very important session. State Farm is such a great supporter of fair housing, not only just the National Fair Housing Alliance, but they support fair housing in general. And your support and commitment to fair housing and equal opportunities is really so important. We wish we had more companies like you. I'm going to say State Farm is not just a good neighbor, you're an excellent neighbor, and thank you so much. I want to start out by talking very briefly about a major investigation that the National Fair Housing Alliance has been undertaking for about the past 4 years now, and I want to run through the investigation and the findings from the investigation very briefly, because I think it really buttresses very well what you've heard from Nikitra and James, but it also helps to illustrate just how critical of an issue and how in-depth the problem and entrenched the problem really is in communities of color. We started hearing from real estate professionals that they saw that REO properties are properties that have been foreclosed on and have been taken back by the bank. So the bank or the investor actually owns these units. And we had been hearing from real estate professionals that REOs, foreclosed properties in communities of color, were being languished, that they were allowed to rot and they were not being repaired. We have conducted over 4,000 site inspections of REO properties across the United States and have found that the problem really is real, that these real estate agents were not just making it up. This map kind of illustrates the point that Nikitra made earlier. The overwhelming majority of foreclosures are occurring in communities of color. These are the Maryland counties surrounding the District of Columbia, and you can see each blue dot represents a foreclosed property, and you see in Prince George's County, Howard counties, predominantly African-American communities, you see many more dots. Again, just illustrating that the foreclosure crisis has hit communities of color more hard than others. As we go out and conduct these property inspections, we're rating the properties on 39 different maintenance and marketing criteria, and we have found overwhelming disparities based on properties located in predominantly African-American communities as opposed to properties in predominantly white communities. If you want to read more about the findings, the investigative findings, you can go to our website at www.nationalfairhousing.org, and we have actually 2 reports that go through all of the findings. But I just wanted to show you just a couple of pictures that illustrate what we have found. This is a house that we inspected in Landover, Maryland. You can see the trash there. The property is uncapped. The lawn is not mowed. It is not taken care of. This is not atypical of what we find in communities of color. And we're looking at houses that are in communities that had high rates of homeownership, communities that are predominantly Latino, predominantly African-American, and then we're comparing them in the same kind of neighborhoods that have those same demographics, but that are predominantly Caucasian. I personally, and I've been on a number of these inspections in Atlanta and Oakland and everywhere throughout the United States, I personally have never seen a home looking like this in a predominantly white community. This is a home that we inspected in a predominantly white community in only Maryland, and so you can see the comparison in terms of the maintenance and the upkeep of the property. This is another property that we inspected in Baltimore in a predominantly African-American community, and you can see there, again, the Cyprex sign, so it's very clearly bank-owned. It is being managed by an asset management company, but you can see the state of disrepair of the property. And the thing that we get back, we have filed about 4 or 5 complaints with the Department of Housing and Urban Development. We just settled our complaint with Wells Fargo that resulted in about $50 million in community investments. Based on our calculations, we need more than $66 billion just to address the problem in communities of color for houses that foreclosed between 2005 and 2008. So for a 3-year window, we need $66 billion. So you can imagine how much we need to address the problem that we're seeing from the entire foreclosure crisis. But one of the things that we get back, we heard it from Wells Fargo, we hear it from Fannie Mae, we hear it from Safeguard, we hear it from every single lending institution or property preservation company or investor with whom we have spoken. And they say, well, this is not really our fault. When the houses come into our inventory, this is how they look. This is the state of their maintenance. These are poor communities. They're not well-kept communities. And then we hit them with this, because when we go out and inspect the properties, we always take a picture of the house to the left, to the right, and across the street. So this is the subject property that was not maintained. The top corner picture is the house to the left. The right bottom is the house to the right. That's what the rest of the neighborhood looks like, except for this REO unit that is not maintained, which is why we got such a substantial settlement with the Wells Fargo case. This other thing that we have found, because we have tracked a number of these houses, the other thing that we have found is that properties that are well maintained have a much higher proclivity to sell to owner occupants. Properties that are poorly maintained have a much higher proclivity to sell to investors. And as a result, as you can see there, a large lion's share, 40% of the homes sold in white communities that we looked at in Maryland sold to owner occupants. Only 23% of the properties in African-American communities sold to owner occupants. Over 50% of the homes in African-American and Latino communities in the Maryland counties that we inspected, over 50% were sold to investors. And that ties in very nicely with the point that Jim just made. So we have a couple of policy recommendations that we think are very, very critical to help address the very broad problem that we're seeing. I'm not going to delve into a lot of these. We can handle it in the Q&A. So I'll kind of run through some of these. I'll stop on just a couple of points and flesh them out a little bit more, but we can talk about these points more in the Q&A if you'd like to. We do think that there needs to be continued and increased funding for fair housing enforcement, education, and research initiatives. This is critically important. We hold the position that if we had had adequate funding for fair housing preceding the crisis would not have been as bad as it was. But because in the years leading up to the crisis, the funding for fair housing was really starved, we did not have enough resources to address the amount of discrimination that we were seeing in the marketplace. We just could not simply address it. And quite frankly, no offense to the current administration, but HUD could not address it. because HUD's budget was substantially restricted. The Department of Fair Housing and Equal Opportunity is understaffed by 200 people. And so you can imagine if you undercut the funding of an enforcement and regulatory agency, that agency is not going to be able to do its job. And that's the exact same thing that we're seeing happening with the CFPB, where there are some members of Congress who are trying to starve that agency so that it cannot do its work effectively. DOJ and HUD need to continue the use of disparate impact in fair housing and fair lending investigations and settlements. To HUD's credit, HUD has always used disparate impact, always. And let me pause for a second to explain what disparate impact is. You have something called intentional discrimination, and then you have disparate impact. Under the Fair Housing Law, the Fair Housing Act says you don't have to prove intent. You don't have to prove that somebody intentionally discriminated against you. If you can show differing treatment, and if you can show that a policy has a disparate impact or a discriminatory impact on a protected class, that is enough to meet the standard for liability under the Fair Housing Act. And that is so critically important because it has allowed us to address the policies and practices of institutions that implement rules, they implement policies that have a discriminatory effect on communities of color. DOJ has just recently, under this administration, utilized disparate impact, which is why you're seeing the number of fair lending case resolutions that you're seeing. And you never saw DOJ taking up these fair lending cases prior to this administration because it would not use disparate impact. So you saw the countrywide settlement, the settlement with Bank of America. Bank of America purchased Countrywide's book of business. And DOJ settled a major, one of the largest fair lending, actually the largest fair lending settlement in our country's history with Bank of America because Countrywide was, as Nikitra described, specifically targeting Latino and African-American communities for subprime mortgages when those people qualified for prime mortgages. And those folks have gone in, many of them have gone into foreclosure. So DOJ used disparate impact to bring that case. DOJ used disparate impact to bring the Wells Fargo settlement, the SunTrust settlement, the prime mortgage lending, the prime lending settlement, the AIG settlement. All those cases used disparate impact. So can you imagine the amount of discrimination that we would have been able to stop from ever happening if DOJ had been using disparate impact all along? We need to, again, I must give a shout out to HUD. We have been asking for the past, well, they have been asking, because I'm not old enough. They have been asking, the civil rights community has been asking for over 30 years for HUD to promulgate regulations to implement the affirmatively furthering fair housing provisions of the Fair Housing Act. I'm not going to go into that because I know Secretary Jones is going to go into that. HUD just issued a proposed rule, and many organizations have submitted comments on that proposed rule. And so now what we need is to have the final regulations implemented post haste so that we can help further fair housing. We also need to have increased oversight from federal regulators. This includes looking at issues like credit access, all of the issues that Jim raised in his comments, critically important. If we don't have federal regulators addressing fair credit access issues in their fair lending examinations, in their CRA examinations, we're going to be in big trouble. We need regulators to look at things like underwriting overlays. What do I mean by underwriting overlays? Well, the large entities that provide funding for mortgage loans, they set out what their underwriting criteria is, right? And today, for all intents and purposes, it's Fannie Mae, Freddie Mac, and FHA. Well, what many lenders do is they say, okay, Fannie Mae and Freddie Mac, here are your underwriting guidelines. we're going to overlay underwriting guidelines on top of those that are more restrictive than what you require. So you tell me you'll purchase a loan for a borrower who has a 620 FICO score. I as the lender, I'm going to mandate that that consumer have a 700 FICO score. So that underwriting overlay now makes it much more difficult for people to qualify for a mortgage. Folks who otherwise could get a mortgage now cannot. The use of non-traditional credit, we know that particularly for new immigrant populations, they use non-traditional credit. African-Americans use non-traditional credit to a much larger degree than does the majority population. We have a lot of lenders who won't even look at a person who uses non-traditional credit. So the regulators are going to have to address that. We need full implementation of Dodd-Frank. Some of the rules that were mandated under Dodd-Frank, the regulators have written rules for that. Most of them they have not. We need the regulators to finish and complete that work post haste. Things like the anti-steering provision. You would have thought that this would be one of the first things the CFPB would address, but it has not issued an anti-steering rule. We need that anti-steering rule. The rules that are issued cannot water down the purpose and the meaning of Dodd-Frank. And we also, as I said before, need to thwart or overcome attempts to diminish Dodd-Frank and to weaken regulatory agencies like the CFPB. The GSEs and HUD must change their REO distribution programs to favor owner occupancy purchases and to limit sales to investors. Right now, it is the GSEs, it is the government institutions. The GSEs are now, they're in the public space right now because of their conservatorship. The GSEs have the lion's share of the REO inventory because they control the market. So they can go a long way. If HUD, if FHA, and the GSEs were to adopt programs that would favor sales of their REO inventory to owner occupants or to nonprofit organizations that operate affordable housing, quality affordable housing programs, we could go a long way to building back the homeownership gains that we lost and also controlling rental prices that have gotten out of control. As Jim and Nikitra have said, and as I alluded to earlier, the majority of sales in communities of color are being made by investors. Those investors, once they purchase those units, they're jacking up the rental rates. And that's why you see the rental rates rising so high, and people are paying more and more of their income to rent. Fannie Mae must adopt a more local and regional-based approach to property maintenance and preservation. We need tax waivers. You all just saw the article in the Washington Post on this issue. And then we mentioned GSE reform. NAFA is in a different position on GSE reform. We're asking people to hold back a little bit. We don't think that GSE reform needs to happen in the way that a lot of people are saying. We don't think it needs to be totally privatized. We want Congress to rethink the idea of privatizing the secondary finance system. We also think that there needs to be an expansion of the Federal Fair Housing Act to bring it more up to date. Credit reporting is another major issue because it impacts our credit scores. There is a move in Congress right now to include utility rates and how you're paying your utility bills in the credit repository system. This will have a negative impact on many communities of color. And then you've heard my colleagues make reference to the qualified residential mortgage rule, so I won't go into any detail on that. Thank you.
Lastly, we will have Maurice Jones, who is Deputy Secretary at HUD. Just leave it alone.
Good morning to everybody. Good morning to everybody. All right, okay, y'all still awake. I know we want to get quickly to Q&A, so I'll try to be brief, and then we can do some Q&A. I want to first thank the CBC and the Foundation for having us here, and to thank you also for the work that you all have been doing for years. I'm grateful to you. I also want to thank Nikitra and Jim and Lisa for the work that they all do, and for the feedback that you always generously give HUD. I always say to people when I go to meetings like this, they are unique opportunities to show love, right? And I usually receive a lot of it. So let me just say a handful of things, and we can sit down. You've heard the facts. The bottom line is that this recession, housing crisis took a brutal toll on the African-American community, no question about it. And I won't repeat the brutal facts, but they are brutal. And to the point that was made earlier, a substantial proportion of the wealth in African-American communities is derived from home ownership. And that was the place that took as big a hit as any other place, and thus African Americans and other folks of color have been disproportionately impacted by this. Let me tell you some of the things that this administration has been doing to try to fight the good fight in this area. And let me start with saying the work is still unfinished. There's a lot of unfinished business. And all of the suggestions that folks have made this morning are things that make sense for us to be wrestling with. Let me tell you what we've been trying to do. The neighborhood stabilization program was mentioned as one of the things that we have been doing and need to continue, if you will. HUD has invested about $7 billion via the neighborhood stabilization program since President Obama took office. And this is all designed to increase affordable housing and to stabilize these communities that have been hard hit by foreclosures. Of the $7 billion that we have invested in these hard-hit neighborhoods, 60% have gone to communities of color, neighborhoods that are predominantly occupied by communities of color. And NSP, despite its flaws and despite its inadequacy, if you will, has been a major factor in helping to stabilize many of these neighborhoods. As I'm sure the panelists know, when a foreclosure sign goes up in a neighborhood, we have seen studies that say that the property value of the neighboring house goes down by $5,000 to $10,000. So a foreclosure sign in a neighborhood damages everybody. As was mentioned, the NSP was a program, I should say additional community reinvestment is certainly needed, no question about it. But NSP has done some pretty substantial work. 75% of the neighborhoods with NSP investments have seen vacancies in those neighborhoods decline, and 72% have seen home prices increase. If you compare those neighborhoods with similarly distressed neighborhoods that did not receive NSP investment. So NSP, again, despite its flaws, did some good work, and we're very proud of it. What else have we been doing at HUD and the administration? We've been trying to shine a spotlight on a topic that Lisa alluded to that's still getting too little attention, and that is that housing discrimination continues. We've done a number of studies of late, and I'd like to tell you about some of them. But the studies basically confirm this hard truth, that our long journey to ending housing discrimination remains unfinished. The studies basically are showing us that real estate agents and rental housing providers recommend and show fewer available homes and apartments to families of color than they do to white families. So the discrimination may be different today, but it still exists. So I'll give you some data points. So if you take into account the ability to make an appointment, the availability of the units, the agent's willingness to show units, minority renters and homeowners are basically told about and shown fewer homes and apartments than white families. Black renters, in a recent study that we published, who contact agents about recently advertised housing units, learned about 11% fewer available units and were shown roughly 4% fewer available units than similarly situated white renters. Same study, we found that black home buyers who contacted agents about recently advertised homes for sale found out about 17% fewer available homes and were shown 18% fewer homes. Housing discrimination continues in this country, and we need to stay on it, as I know Lisa and company are doing. What are we doing at HUD? Well, over the past 4 years, our investigative efforts and those of our partners at the state and local level have helped more than 28,000 individuals that were subjected to housing discrimination and have resulted in more than $65 million in compensation. A couple of examples. On the 27th of June of this year, the U.S. District Court for the Middle District of Alabama approved a $35,000 settlement that resolved a Fair Housing Act race discrimination lawsuit that Justice filed following a charge brought by HUD. The lawsuit alleged that the owners and managers of a mobile home park in Montgomery denied housing to an African-American woman and her family because they were African-American. September 16, 2013. Just remember, this is not the 1960s that I'm talking about, right? I'm talking about this year. And I could have given you some examples from last year and the year before that, but I just want to give you this year. September 16th. What's that, 4 days ago? 4 days. That's just for your information, that's 2 days after my birthday. So it's not too late. No, I'm joking. I'm getting distracted, right? Yeah. On the 16th, Monday, we announced that the owners of 2 apartment buildings in North Arlington, New Jersey, not in the South, right? North Arlington, New Jersey, they're going to pay $21,000 under an initial, what's called an initial decision and consent order that resolves allegations that the owners violated the Fair Housing Act rights of individuals by denying rental opportunities to African-American tenants. They refused to show apartments or return calls to prospective tenants after they learned that they were African-American. So, more work to be done here. We are aggressively pursuing these cases all over the country, as I know others are, and our state and local partners are, and it's still out there. Additionally, we're trying to use technology to play a role in this fight. We unveiled a housing discrimination app in February of this year for the iPhone and for the iPad. And so with a few swipes of your finger now, you can learn about your housing rights and you can pursue complaints of discrimination in the housing area. What else are we doing? Lisa mentioned the affirmatively furthering fair housing proposed rule that's on the street. I need to thank Lisa and her colleagues for being, I should say, showing stamina in helping us to get this proposed rule on the street. It has been a long journey, but it's out there now. It does a number of important things. It clearly articulates what we mean by affirmatively furthering fair housing. It provides a template that will replace a current analysis of impediments to fair housing that needs to be replaced. We're going to bring data to the table for local governments and others to use as they plan housing and fight unfair housing. And we're going to provide technical assistance to folks to help them get better in this area of affirmatively furthering fair housing. The comment period closed on this proposed rule the 17th of this month. We're going to take those comments, revise our rule, and get it back on the street in as quick a fashion as possible to finalize it. I want to thank folks who've already been giving us feedback, and we look forward to getting it out there in final form, and hopefully it being a tool to help localities continue to better plan when it comes to furthering fair housing at the local level. And then let me talk about the FHA a little bit, because the FHA has been mentioned. The FHA has played a critical role in this crisis for communities of color. Let me give you some data on that. Since this president took office in 2009, more than 362,200 African-American households have purchased a home using an FHA guaranteed mortgage. And over 214,000, actually closer to 215,000, have refinanced, in many cases dramatically reducing their monthly payment or getting out of a risky adjustable rate loan. To date, during this administration, the FHA has financed, or FHA financing has been used by almost 30% of first-time home buyers and 50% of all African-American families who have purchased homes since this administration started have purchased a home with the help of an FHA guaranteed mortgage. So is there more work to be done with respect to the FHA playing a role in this space? Absolutely. But are they playing a critically important role not being played by anybody else? Yes. Absolutely. So I welcome the critique, but I don't want you to miss the point that I proudly stand behind the work that we're doing here and take all the critique, look forward to getting better, but the FHA is adding value for communities of color all around this country. In fact, as of July of this year, over 952,000 loans for African Americans are in the FHA portfolio. So I'm going to be quiet and sit down. But is there more work to be done here? Absolutely. Is this administration fighting the fight for folks of color when it comes to housing and economic recovery and revitalization? Absolutely. And we look forward to continuing to fight it with you. Thank you very much.
Thank you. If there are any questions, there's a microphone here if you want to step up to the microphone. I actually wanted us to delve a little bit more into how neighborhood revitalization efforts are affecting where African Americans live. I think that was somewhat missing from the discussion, and I know Marjorie is definitely interested in hearing more about that. So if one of the panelists wants to talk about that a little more, that would be great.
was going to make a comment that relates to that based on something that Lisa had pointed out about Prince George's County. So in an article in the Washington Post earlier in the year, it pointed out that also in Prince George's County, there are more than 50,000 properties listed on the foreclosure registry. And they were pointing out that that huge share of properties on the foreclosure registry were actually contributing more to foreclosure because, as you saw in Lisa's film, and I thought it was really, really powerful, that photograph, you have people who are still paying their mortgage and they want their neighborhood to survive, but they can't do it because the county just simply doesn't have the funds to actually pay for the upkeep of those properties. And as you heard from Lisa, the servicers aren't doing it either. So that is another point on the community reinvestment side that I think we need to focus on. And so what happens is those households ultimately default on their loans, they walk away, the properties drop in price, the investors come back in, and then the whole process starts all over. 2 points I want to make about NSP. My concern about and real criticism about NSP wasn't about HUD or the program, it's about Congress priorities. Because if you divide the NSP funding by, as Maurice said, about $7 billion by the number of years since we've been in the crisis is 6 years, since the number of years since the first round of NSP funding is less than $2 billion a year. That was the point I was trying to make. As the communities finally started understanding the rules of the program, because it took a lot of time and a lot of energy to come up to speed with it, it was a new program, it was a creative program, the funding disappears. And that's a congressional priority that needs to be overturned. And the final point I want to be clear about FHA, because most of you know I've probably written more articles on FHA and the value of FHA this year than probably anybody else. And I've gone head to head with the American Enterprise Institute in some very high profile public writing debates. My point about FHA is not that it's not doing a great job, it's that FHA is the only game in town, and that the conventional market cannot be closed to people of color, and we can't talk about recreating a mortgage finance system that's privately financed with taxpayer backing and then say, oh, but if African Americans don't fit in neatly into the credit box, then they should go back to FHA. That is not FHA's role. FHA should be playing that role of first-time home buyers and people who don't meet the standards in the conventional market. But more than half of African Americans going to FHA means that we are being precluded because we are credit-worthy borrowers.
And so let me just say one point. Excuse me, is it okay if I take that? Yep. Let me just say one point in answer to the question that you raised, Anisha, and I know Marjorie really, this is a really critical thing for her. We don't have all of the evidence in, and we have reached out to some of the regulatory agencies to ask them to help us to get this data, make it more readily available and more publicly transparent. But the data that we do have access to, we are seeing that in many communities that were solid African-American or Latino home ownership, those communities, the homeownership levels have dropped substantially. So for example, in Prince George's County, the homeownership levels have dropped substantially. Some of the suburban communities that we've been looking more closely at in Georgia, outside of Atlanta, Georgia, the homeownership rates have dropped by as much as 50% in those counties. We don't know where those people are. We don't know where they've gone. We don't know where they're moving to. And that's the critical component for us. We don't know if the programs that have been put in place are actually resulting in helping to expand housing opportunities for people, or if people are being more heavily concentrated in communities that have higher rates of poverty and the like. What we do know anecdotally is that people are home sharing more.
Okay, we'll go ahead and answer some audience questions. If you can say your name, maybe where you're from and your organization, but not your life story. Just thank you.
Hello, my name is Rance. I just finished grad school and I'm going to work at the Community Builders. My question is, I guess, about neighborhood revitalization and the housing value sense of it, that, housing values fall and then it's harder to get renovation financing because what you're going to sell the home for is not enough to cover the work. And it seems that, if everyone was to go all in and, if everyone was to renovate the homes, the prices would go up and then you could get more. And so it seems like a collective action issue. I was just wondering, how are we trying to get around that? Particularly when, whether it's cash purchases, the concentration of foreclosures, all these things pull down the housing values in, communities of color.
So it's an interesting question. I don't know if I can answer directly, but let me sort of grope around the question a little bit. The challenge that we're seeing in African-American and Latino communities is that the investment is not happening by African-American and Latino owners. It's happening by investors, and investors are crowding them out. I said that there are some downsides to investors. I didn't mention all of them, but one of those downsides is because they buy for cash. They don't have to get an inspection or an appraiser. And so because they don't need an appraisal, they can pay either more or less than what the property is worth. So you tell me, do you think in African-American and Latino neighborhoods, the investors are paying more or less than the properties are worth relative to what they bid on them for in non-Hispanic white communities? So it's possible that those investors are actually driving down property values in black neighborhoods and helping to perpetuate flat real estate prices that drive more people into foreclosure, at which point they buy more properties. Another problem is, even in scattered site, institutional investors are new in the housing market buying scattered site single family. We don't have a clue what that's going to translate into in terms of property management, because a lot of these hedge funds and other funds that are just getting into this buy individual properties have no experience as landlords. So that's another mystery question in this whole community revitalization question that you're asking, which is why I'm saying I can't address it exactly, but I can say there are a lot of things going on there. Another thing is that because investors are buying for rate of return, not the American dream, if that rate of return on that property doesn't meet their standards, because they've bought in bulk and they tend to be heavily concentrated, they can turn and drop those properties just as quickly as they purchase those properties, which means even if you see some signs of life, if investors are overly concentrated in a neighborhood and the return on equity doesn't meet their standards, those house prices could be driven back down again. So I guess my sort of walking around this question about community revitalization is this is not a normal economic market nor a normal housing market where you can just talk about investment by an individual, what is likely to happen to that community, because we don't know what's happening with that big wild card called, first of all, absentee landlords and the institutional investors, which is a level even higher than that. And then the final thing I'll say is, if you look in most black and Latino neighborhoods that are moderate income, you'll see high unemployment rates have translated directly into a loss of tax revenue, right? And so real estate and other tax revenue. What that means is that there is an enormous amount of unmet public sector investment need. So those neighborhoods are deteriorating. So you have to add that onto the pile, which is why I'm so sort of adamant about Congress or congressional failure to really understand the need to invest in community investment. What are the public sector dollars that are being brought to the table to help communities rebuild? There aren't any that I'm aware of, with the exception of CDBG and some other basic programs, which of course are under the Budget Act as a result of the crisis. So this is a very curious market, and using sort of your standard template of investment buy and this happens, it's not necessarily going to work out that way in this market.
Thank you.
Anisha, I'm sorry, sir, I forgot your name. Deputy Secretary Jones and I are just sitting here trying to do some math and figure some things out. But the Wells Fargo settlement that I referenced in my comments, we believe resulted in $42 million for community investments for just the purpose that you mentioned. So it's grant dollars. It can be used for property renovation. And we believe it's in 31 cities. So if you go to NAFA's website, you can get more information about that. I think it's also on, the settlement is also on HUD's website. It is on HUD's website. You can go to your local fair, contact your local fair housing agency, and then they can tell you if any of those grant dollars are available in the communities that you're thinking about working in.
And can I just comment on that just really quickly? So But those investments, you have to understand, they're more of a statement, right? Rather than a turnaround. Because you divide by the number of states, you're talking about really $1 million, right? And then you divide by the number of communities. So it's not as if there are these dollars that are available as a result of these successful legal actions. And I think we need to keep that in mind, because when you see it in the papers, that it's really powerfully put forward. You know, we've gotten a $41 million settlement.
Right.
But we lost more than $7 trillion in housing wealth. We've got about $5 trillion still outstanding. And the recovery in house prices has not come back to African Americans because we've actually lost our homes. So rising home prices aren't actually helping us to the extent that we are no longer owners, we're renters. The rising home prices are actually driving rents up for those families. So we're not equally benefiting from the return in prices. So again, this is not your mom and pop's reinvestment era. You really have to be very granular to understand the kinds of questions that you're asking. You need to know it at a neighborhood level, a community level, things of that nature.
Thank you.
Good morning. My name is Sheila Cross-Reed. I'm a real estate broker and affordable housing developer here in Washington. I want to thank you for your presentation this morning. Actually, this room should be overwhelmed with people. This is such a serious issue for African Americans. My question primarily is in regard to credit. I find that the systemic discrimination that we see in credit is one of the most insidious barriers to home ownerships. The Fair Isaac rating system, which equates, it uses the same criteria for someone who's a working class African American as someone who's a broker on Wall Street. What is being done about that? Because this is one of the things that I find overwhelmingly keeps people out of housing and access to equity or access to home ownership. What is being done? I don't see, we know it's a problem, but what are we doing about that?
You raise a very important point, one that we all glossed over much too quick in our comments. It is an incredible barrier. And because it is an incredible barrier, we have we have myriad fixes to try and address the issue. So we've done a lot of work. The first thing that we were able to do is to keep credit scoring out of the rules that Jim and Nikitra alluded to, the qualified mortgage rule, as well as the qualified residential mortgage rule. Now, the qualified residential mortgage rule is not complete. The regulators are writing that now, but we believe that we've kept it out. So you had lots of people in Congress who wanted a FICO score or a credit score included in the mortgage rule to mandate that you had to consider a credit score when you're considering whether or not you can give someone a loan. That is not the case. So that's number one. And that was a Herculean effort. So we kept down payment out and we kept credit score out. Number two, the qualified mortgage rule says that if a loan is acceptable or meets Fannie Mae, Freddie Mac's, and FHA's guidelines, it is considered to be a qualified mortgage. That was critical for us, for the civil rights community, because neither FHA nor the GSEs require you to have a credit score in order to get a loan. They all use and accept non-traditional credit. As long as you can verify and document that non-traditional credit, Fannie Mae, Freddie Mac will buy the loan and FHA will insure the loan. So we are currently meeting with both Fannie Mae, Freddie Mac, and FHA to get them to more aggressively push their non-traditional credit underwriting guidelines and to talk up their non-traditional credit guidelines so that lenders will make loans to folks who utilize non-traditional credit. You don't have to have a FICO score to get a loan. The reason that you go to a bank and apply for a bank to get a loan and the bank tells you, well, no, we couldn't give you a loan because you don't have a FICO score or something like that, is because that is the underwriting overlay issue that I alluded to, and I do apologize, I glossed over it very quickly, but the bank is putting that requirement on people. The bank is the one who is laying on that extra requirement. So now comes the work of the federal regulators to reach out to banks and say, you can't do that. And so that's another piece of the work that we have. And then the final piece is the enforcement piece. We are trying to figure out a way, quite frankly, to sue lenders who are utilizing those credit overlays and making it much more difficult for people to get mortgages.
And Lisa,
Yeah.
just, okay.
Can I add one point on credit scores? One of the reasons why we fought so hard to get Dodd-Frank and the Consumer Financial Protection Bureau in place is because we wanted to put underwriting back in lending. For many lenders, credit scores are one aspect of overwriting. It's one factor among many to consider. And we are, in the self-help division, a lender. So we know how to look at a borrower and make determinations. So part of our efforts was to insist that the ability to repay test in particular was included so that lenders would actually do real underwriting. There is a benefit to some of the manual underwriting that has occurred, but it's overly relied on. And part of Dodd-Frank and the ability to repay test under qualified mortgages will put that consideration back into place.
And
So
just
we are actually, it's 2:02, so I'm sorry to cut everybody off. Yep, I'm sorry, 12:02. Yeah, 12:02. I missed the one. We will take one other question from the lady behind us, and then we will go ahead and have final remarks from our panelists.
Hello. Thank you for this affair. My name is Marjorie Beverly Hunter, and I have a bill that I'm trying to work on for legislation, and it's a bill that will pay directly to the landlord owners who rent to tenants. Of course, it would have to be a new housing office open up whereby the landlord owners will go in there and let the office know that they are renting. And the government will pay the landlord owners a check for their rental services, because there are many tenants who do not work, some are sick, and presently they are scamming the landlord owners because they do not have the money to pay the rent. And in this way, the society would be a more stable place to live. Presently, as you know, with the foreclosures, you look around and you say, well, where is housing? They're not helping. So I would make the suggestion to you to pay these homeowners, people who are trying to buy a place. Let this housing money go directly to these people who need the money, instead of taking the money and throwing it around the circle, causing folks to lose their homes, because that's what's happening. It's too much of it happening. And of course, like my bill for legislation, I'm hoping it will go through and pass, because this will cause people to be more stable. They'll have a place to live, and the tenants they have will not be running all around the circle, and this will help the foreclosure. And that Wells Fargo, when I tried to get a refinance mortgage, they told me I had to pay $3,000. So I said, if I pay $3,000, it would not benefit me in it. So is there any way that you all can tell these lending folks not to ask people to pay thousands of dollars, $3,000 or $4,000, just because they want to refinance? Because at the end, they don't gain anything from it. They lose.
Deputy Secretary, I believe you.
Just a quick comment. Your legislative proposal sounds a lot like HUD's housing choice vouchers, which we have now. Do we have enough of them for what's happening with respect to demand now?
No. What I'm saying is something different.
Okay.
It is something new. It is something that I have experienced. Now, I know for a fact that I have made at least about 50 calls to these different little housing groups and organizations and 501c3s. They have given me no money, nothing. I mean, I went 1 year without getting 1 cent of rent. Because, see, the tenants, they will scam you if they can. Some may be honest because they're not working or sick or something. But what I'm telling you, sir, and I know you know it, a landlord owner cannot just get money from the housing when they ask for it. Why? Because the way the thing is set up presently, the tenant has to be the one who go and asks for money. So if the tenant don't go and ask for money, you're out. And see, all of us sitting in here, I mean, if we could rent out our places, get money from the government, let the government pay us directly.
As opposed to the tenant going to the government for the housing program, the landlord has that.
Correct.
propensity.
That's my proposal. Let the landlord go. She's the one, or he's the one who have this great big expense. And then another thing, is there any way that you all can squash this real property tax assessment from rising? That is what's causing us to lose our properties. Well, see, that's something y'all need to do. I'm serious.
We can do that.
I mean, it's a crime, the way the thing is going. It's just a real crime.
We could do that, we would do it.
Homes and everything. It's unfair.
Well, thank you. We really appreciate your comments. And I just want to kind of use this as a moment to recognize the importance of civic engagement, no matter what age, no matter how young. And I think this is a really good example of how we have to stay engaged on these issues. And I'm really heart-wrenched by you coming and sharing with us today. I know we didn't delve into all of the issues we wanted to. We didn't talk about principal reduction. We didn't really talk a lot about gentrification. So this is definitely an ongoing conversation. But that will definitely lead us into our final comments from our panelists and maybe one key point from today's discussion, and then 2, what advocacy tools participants today can kind of go away with as they go back into their local communities.
I'm just going to repeat the words of Frederick Douglass: agitate, agitate, agitate. We can't get anything done unless you all reach out to your members of Congress and push on your end.
And I just want to end by saying we have a one-pager out in the lobby, and we ask everyone to take that because it talks about down payments, and it's a bunch of information here so that you can have conversations with your representatives and let them know that you don't support these down payments. And we have support for our down payment position from NAFA, from Leadership Conference, from the NAACP, National Urban League, and the National Council of La Raza.
I'll just build on the comment from Onisha and Lisa. If you look at the totality of problems we face, you realize that they are multifaceted. And the only way we're going to get a grip on this is by getting both Congress and the American public to understand it's important. So we need to be mobilizing. And we need to be mobilizing more than just for one march in D.C. We need to be mobilizing more than to just write your member because your member got elected by you, therefore they already know what you want and they're probably already voting for you. So it's good to write to your member, but it's better to have those members who are voting against us understand why this is important to them. We need a major national mobilization, and where and how that happens, I don't have the cookbook for it, but unless we get it, we will not be moving forward in the way we can. We must mobilize.
I would just say ditto to all of that. I have to be a little careful here, but let me just also leave with this fact. In 2005, 60% of the net worth of Black households were in their home. 60%. And so this, and I think this was alluded to, I think Jim mentioned it earlier, there's this conversation that is talking about rebalancing between renting and home ownership. We cannot give up home ownership as a priority. If we do, Black households will be disproportionately harmed. And we need to be the voices for that.
Well, I just want to thank all of our esteemed panelists. They did a phenomenal job discussing this very complex issue. And I will now turn it over to Dr. Innocent, who will give some closing remarks and discuss the evaluation form.
Yes, thank you, Onisha. And can we get a round of applause for Onisha, too? Didn't you do a fantastic job? We love her so much. You all probably have heard this already. We really do value your feedback. Most of you should have gotten a survey on your way into the room. If you have not, I have copies here. If you could please take a moment, fill it out, and share your thoughts with us. There are also sign-in sheets outside. If you have not left your information with us, please go ahead and do that too, so that we can let you know in the future about other work that we'll be doing around this issue and the other issues that we focus on as well. And really around to you all, because you really were absolutely fantastic. Thank you for your excellent questions, really. Please enjoy the rest of the conference and the rest of your day. Thank you.